Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, our telephone number. Write down that phone number, ask your questions, give me a call. If you do not get through on the show, please leave a message with these questions, or you can email me, info@malibufunding.net. Malibu Funding, nice company, sponsors the show, has been for the last 5-6 years. And when you do either call or you write or you ask your question, anticipate that you're going to get a quick response. Why? Because we think that the connection between what you ask and what we need also, affects everybody who's going to listen to the show. So we want to bring those stories to the show, people who get some success at the information that we give them, the power to make better decisions. I hate those kind of words. Do you like those kind of buzzwords that they say all over the airwaves?
No, not really.
Empower, I don't know.
Empowering.
Yes, all the stuff that, you're like, well, what does that even mean? I'm not a lawnmower. I don't need gas.
Virtuous.
Yeah, virtuous is another one. Anyway, so welcome to the show again. I'm Jeff Barton. Let's see. I'm a little tired this week, and I think that there's a lot of things going on both in the news in relation to business and politics and everything else. Plus, we're fastly approaching Halloween, which is kind of the bellwether, the benchmark between summer and fall for a lot of people. I know that there are some differing opinions, but once it hits October 31st, you are into pretty much Thanksgiving, Christmas, New Year holiday. This is the kind of the triumvirate, the triple threat. And so parents who are driving around out there who have kids in school know exactly what I'm talking about. You start to begin to hunker down and think about what's going to happen for the rest of the year. So there are opportunities in the real estate buying world as a result of that, because a lot of people just refocus what they're thinking on, and they say, okay, I'm going to do just this because I have, 2 kids, one's over here at school, another one over here. Got to think about what's happening for the holidays. I know Thanksgiving we're supposed to go to Uncle Larry's house or whatever it might be in your particular case. And then, of course, the Christmas holidays is all about getting excited about presents and trees and, if you're of that persuasion that celebrates those things. And even if you're not, you get swept up in it. Why? Because the good old US of A is nothing if it's not really geared up for selling you stuff. And that's one end of the year that they really want to sell you everything, right?
The Christmas sections are already being set up. So forget Halloween, forget
right.
Thanksgiving, we're going right for the throat.
Yeah, I saw an article about that online too, just to say, what happened to, Halloween? Well, they've gone right to Christmas, like you're saying. So this is a great time, as I said, in real estate. A lot of people in real estate think to take their houses off the market at this time of year, and I always think that that's a bad decision. The reason is because I think there are many buyers that are still out there and still looking, although they're less and the pressure to buy is less. You, as a seller, having fewer properties on the market is probably a good thing in that if you're having trouble selling it and you want to continue to keep it on the market, it is a good idea.
Well, there are people that are hung up in their jobs and all of that during the week and really can't take the time off. And
that's true,
too. Sometimes those 4-day weekends or the holiday weekends or the holiday weeks, that's the only time they can free themselves up to go look.
Speaking of that, we just had a holiday weekend. Columbus Day was just passed. Do you celebrate Columbus Day?
I have not. What do? You get in a boat, you head to the West Indies and then sink the boat?
It's a holiday that is lost on the younger generation. It doesn't really mean much anymore, especially with the sensitivities of Native Americans and some of the other obvious problems Columbus brings up every time you bring up, imperialism and nationalistic approach and death for millions. Yeah, that's a problem with me too, but...
Yeah, disease.
Yeah, all of that, exactly. So they're replacing it with a natives person's holiday, right? They're transitioning, at least here in California. Maybe back east it's a bigger holiday than it is out here. But go on, sorry.
No, I was going to say I hadn't really heard of the native person's
Oh, yeah,
holiday,
this is a
but
big push
does it
now.
have a name?
Yeah, I think that's what they're calling it. They're calling it Indigenous Peoples Day.
I like that.
Yeah, it's much better.
Yeah, I like that.
It's much more rounded, and it also incorporates the people who obviously were here at the time, which, they just got
go
wiped
visit
out
their-
with the disease and
Their
everything
current
else.
place of business.
Yeah, yeah. So, okay, so I'm tired, and I'm tired for many different reasons. And I'm tired, and maybe you're out there, and as I've described the parents at this end of the year and what happens in the real estate market, the opportunities that might be available, what do you do for relaxation? A lot of people call it me time, right? But still, there's rushing around, and I can't tell you that the schedule that I'm on recently probably is nothing compared to yours, but for me, it's extremely busy. So I wanted to spend a couple of minutes talking about how do you relax in a situation like this. We usually have Dr. Jeannie Bartoli on. She couldn't make it today, but I did want to hit the topic. And from my standpoint, relaxation is about enjoying what's in front of you, not rushing to the next thing. And I think we get caught up, especially this time of year because of the holidays and everything else going on, and forget to, slow down a little bit. I was driving frantically over here, and I go, what am I in a rush for? So I kind of geared it back to, 80 miles an hour. And, of course, that's the typical drive out here on the 10 and the 101 and a couple of these other freeways that inhabit Southern California from the Inland Empire all the way to the ocean. But, so what do you do? What do you do, Daryl?
To relax?
Yeah, just to take it off and, kind of dial it back a little bit.
As little as possible.
Okay, so you watch television, or you just hang out, listen to music?
TV, movie on occasion, you
Yeah.
know, and just I like the proximity to here to the ocean is nil, and I just don't go there.
I don't go there.
Yeah, I realize that.
I live at the ocean, and
Yeah.
I don't go there.
So
Okay.
my wife and I have decided that if we're going to live close to the beach, we're going to go to the beach every once in a while.
Mm-hmm. Yeah,
and,
I
do all those things.
So, if you're out there and you're listening to the show and you're wondering, what the heck is a mortgage show talking about relaxation for? The reason is because you buy this house, you struggle. I know what a struggle it is, and that's why the rates, and we'll talk about that in another section, the rates are terrific still, even though they've gone up some. They're great. And so your affordability and what you can get is terrific. But if you don't spend time taking a breath and enjoying how hard it is, how hard it is to get this property, but to take 5 minutes and kick back in the lazy boy or easy boy or whatever they call that chair that kicks back and just begin to enjoy it, then what is it all for? You have children, they're going to be running around. You got to drive them here. You got to make sure that they make all their special events, especially on the weekends. I know so many parents, friends of mine, are driving their kids all over, heck. Either it's for soccer or some kind of club team. Even football is taken over. I have another friend whose son is at Westlake High, and he's just killing it. Trying to make all the games, make all the practices. There's a lot of pressure. But if you don't take the time to enjoy the property and that mortgage that you work so hard to be able to afford, then you're missing out on why, in fact, owning a home is such a great idea. It's a great idea because you get to really enjoy it. You get to say, this is mine. I'm going to take it easy. I won't do anything. I'll sip lemon juice or whatever it is that you do.
They call them staycations. There's a name for it.
I love it. I mean, we're in a new studio here, as some of you may know on the show, and I love the new studio. And you've moved how many times in the last 3-4 years?
The studio has moved 4 times in the last 5 years.
Right.
Yeah.
Exactly right. Well, I
total
like
of 6 or 7 at least.
I like this location. I hope it's permanent. It's more relaxed. It's more out in the country, which I like anyway. All of the things that bespeak of enjoying your life is why you work hard for the mortgage you pay for to get into the property that you really have waited for. And so for those of you who do not own, the idea to be able to get into something is still terrific now. Less people on the market because they're rushing around. Low interest rates can get you an opportunity to purchase something so that when you're sitting back on a Saturday or a Sunday afternoon and just enjoying that you own, That is a terrific feeling. I know because I've done it, and I've been able to enjoy my home for years. So that's my plug to home ownership and why. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks, Daryl, for jumping in. I appreciate it, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929, our telephone number here at the studio. Give us a call so we can help you with your decisions that you're going to have to make about buying or selling. It is a great time of year. A lot of people jumped out of the market. Why? Because, as we said in an earlier segment, there's just a lot going on between now and the end of the year, family-wise. So people that are either where they are or they've got a house already, they're not thinking about getting out there and buying something or getting a new mortgage. That's why it's a terrific time to do it, because less competition. Also, rates are smoking, went up a little bit this week, but they are still unbelievable. And here to lend us a hand as to try to figure out what's happening next, or really what's going on right now, is Charles Giscombe, who is a qualified employee for Malibu Funding out in the state of Nevada. Absolutely. Charles, how are you?
Great, Jeff. How you doing today?
You know, I'm okay. I'm a little tired, but that just because I'm burning it at both ends. I don't know if we talked about it a little bit a couple of weeks ago with a different guest. When the mortgage rates fall, everybody in the mortgage industry gets real busy, and it really, after a while, and we've been doing this for 10 years now, it gets you tired. So that's kind of where I am. How about you?
Same, Jeff. Everybody wants to jump in. The rates get this way, and the refinance market comes back into play. And you have a lot of individuals that want to take advantage of that. And so, everybody wants to jump on that low rate and get that fixed rate while they can, Jeff.
You do most of your business with referrals. Certainly you have new clients all the time. But in order to keep a referral, in order to rely upon that as business, you have to be very good at what you do. Give us an example of how some of the non-traditional products are helping your clients today.
Oh, man. You know what, Jeff? It's so funny, man. We do a lot of traditional loans at Malibu Funding, obviously, Jeff. People don't know. We do, FHA, VA. We do Fannie, Freddie. We can do all those types of loans. But the non-QM loans, the non-Qs, have come into the market, and they're taking the market by storm now.
Yep.
Before it was not as much so, is because the rates were usually higher, obviously, with that type of product, because that product is less strict, less red tape, allows you to get through the door a lot easier, pass least resistance, so to speak, in regards to loans. But now, what has been happening is that because people have been becoming more comfortable, companies, private banks, and banks are becoming more comfortable with this product, and now starting to become more competitive rate-wise with the traditional market. And now when that happens, that's when the frenzy starts, because you have to, where I usually would sell an FHA loan at a very low interest rate, okay, now I come in with a non-QM loan, might have a little bit higher interest rate, but I don't have upfront mortgage insurance. I don't have a monthly premium. So what happens is now that interest rate, even though lower on the traditional, still stroking the same check every month as a borrower, because you don't have the mortgage insurance and different things involved that you would normally have. And these loans, once again, have less red tape, allow more people to get into the market, because people that don't normally have the proper documentation or their business is not structured that way still can transact, still can get lower rates, still get into the market and be happy and be competitive.
I agree with what you just said. I think that there's opportunities here, and for people who are not savvy, you got to get with somebody who actually can figure this out for you or help walk you through it. I think you're one of these people. There are certainly a lot of them in the mortgage business, but you want to be able to find somebody, in my opinion, who can help explain it to you so that you can make some really, sound decisions, as opposed to just, whatever, first guy in the door gets the deal. And I think that's where a lot of what you do and a lot of what the people at Malibu do is to try to help people figure that out.
Absolutely, Jeff. You know what? We always like to say that, we're not the brightest. We might not be. We're not geniuses, Jeff, but we most certainly will sit in front of the problem a little longer than most. And when that happens, we solve the problem. And we like to tailor fit our business and structure these type of loans around individuals who feel like they don't have any other option.
Right.
A lot of times when we have these conversations, Jeff, these people are super surprised that these products even exist. They don't know about them. A lot of people aren't presenting them or putting these in front of them. And so at the end of the day, when the market crashed with us, since we were in Nevada, there were still people out there that had money and could transact. They just needed a product that would tailor fit to them, that would allow them to get into the market and still be able to buy. And that's what these programs do. That's what I like to say. I try to master this, learning every day, but I'm helping more and more people every day with these types of loans.
Give us an idea of a specific program that you're really in love with right now.
Let's say, for example, we had a Anoni. Anoni is a non-owner, no-income program.
Right.
People say no income. Yeah, they still exist.
Right.
There still exists of loans out there that you can get into. Now, let's say, for example, on a non-owner, a no income. Well, normally on a non-owner or a commercial or an investment property deal, you still have to come with your tax returns.
Right.
You still have to come in with your 60 days of bank statements. You have to go through the whole process and protocol normally with a traditional loan. But with this NONI product on a non-QM, we can simply take bank statements. So you can take 24 months of business bank statements or 12 months of personal bank statements, and now even sometimes 12 months of business bank statements. I can even go in certain states as low as 3 months' worth of bank statements. That would take the place of your tax returns, which would allow you then to take the deposits that are you putting in your account and utilizing those as now your monthly income. So now your tax returns are written down all the way off. Now your monthly income is low. But with those deposits, you can look strictly at your deposits. And now your deposits are what going to determine what your debt-to-income ratio is. And that makes things a lot different in regards to your qualifying. And that means when you qualify that way with those deposits, now debt-to-income ratio is not an issue. Your liabilities don't take control of the loan. And now you're able to transact, breathe easy, and know I'm qualified for this loan. I have enough. I make enough money. And the key word that we tell people is you just need to show that you have a decent credit profile and you have the ATR, which is the ability to repay.
Great loans, great way to explain it. There's also a product out there that the property itself gets approved, right? Whereby the rent, the principal, interest, taxes, insurance are paid off by the rent, and that in itself can qualify you for a loan.
Absolutely. A DSCR loans are the same. You can qualify that way. There's so many different programs that we can sit down. It's just a matter of an individual sitting down and saying to us, this is what I have. You know, sometimes you go into a traditional situation and you say you have to fit into this box. Right? And someone comes and they say, I don't fit into that box. But now we're coming to you saying, show me what you got, and we'll have a box that you can fit into.
Right.
And that's the key, is tailor fitting it for them. And at the same time, Jeff, giving them an opportunity to know, like, hey, there's stuff out for me, and it's not going to be so high priced and so, out of the competitive market as regards to rates is concerned. These loans now are very competitive to traditional rates. You'd be surprised that you can get into one of these loans in the 4s and 5s. That's amazing. They used to be 9-10% loans, Jeff.
How do you get your borrowers on your team as opposed to your borrowers feeling like you're selling them?
Well, at the end of the day, this is it. A lot of times, they go to traditional banks. They don't want to show their tax returns. We always talk about this as in a joke, and I don't mean this in any bad way, but I say the IRS makes legal people think about doing illegal things, Jeff, sometimes because they want to keep their money. But people really are saying, do I have to? Am I not going to be in the market, or can I not be in the market because I have a lucrative business, but I write it off? No. So what happens is I just tell them, if there was a way that you could get qualified for a loan using this format, using this formula, would that be something that you would be interested in? And they say, If we had a loan like that, we would have did it yesterday.
Right.
And I say, it's here. And at the end of the day, I'm not selling. Jeff, we're not the best price.
Right.
We may not be the fastest loan, but we're going to sit in front of the problem, structure and tailor this something for you that's going to meet your need. That's going to make sure that you're comfortable and doesn't get you out of your comfort zone. And I think that when you provide that word gets around. Individuals know that these individuals are problem solvers, but we're really not problem solvers because it's really not a problem. It's just a matter of a product being out there for somebody to jump on and say, hey, listen, this is me and I can do this.
Hey, could you shout out your phone number for people who are looking for a terrific loan officer, especially in Nevada or California or down in North Carolina?
Absolutely. To reach me direct at 702-328-5191. That's 702-328-5191. Or you can simply email me at charles@malibufunding.biz. That's charles@malibufunding.biz.
Charles, thanks very much for coming on the show. I really appreciate it. Great as always. Thanks very much.
Love working with you, Jeff. Thank you so much.
Okay, man. And I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number. Pick up the phone, give us a call. Let us help you make some decisions. It's a great time of year to buy. It is cooling off in some sectors at some times of the year, and this is one of them, the real estate market. Although one of the things I saw online when I do the research for the show, and also as part of the job that I have over at Malibu Funding, the company that sponsors the show, their NMLS number is 79620. They look at a lot of the same things that we look at for the show, which is the availability of product on the market, the interest rates, who's working, who's not working, how do we get someone into a home who not necessarily would qualify for a 30-year fixed-rate mortgage. Some of that is how we help. The non-traditional type loans that we talk about on the show all the time are called these non-QM loans, non-qualified mortgage. The non-QM loans are like the bank statement loans that have to do with no income, no asset, NINA loans. I happen to love the loan where you have a lot of equity in the property, but you're not necessarily good on the financing side, or you're meaning that you don't have a lot of money. So if you have a lot of equity in the property, there are people who will allow you to borrow money based on the amount of money you have in the home, and they will try to set you up with a loan to be able to do that. That's a company called Angel Oak, and there's another one called Citadel. Both of these companies are really good non-QM lenders that we use all the time over at Malibu Funding when we're trying to fund loans. We had a person who is going to be on the show in this slot right now, Nina Penny. She's unable to attend it, but what I wanted to talk to her about today, and she is a terrific loan officer as well as an expert in reverse mortgages. Reverse mortgage is another great way to be able to purchase a house. And you say, what do you mean, reverse mortgage purchase? And I say, yeah, a reverse mortgage purchase. So you put 50% down and you never make another payment. That's basically the boiled down version of it. It doesn't necessarily mean that you, here's a scenario. You sell your home because you're dialing it back. You're older, right? You're past the age, you're 62, 65, 68. You want to retire. You don't want to spend money on your house anymore. But you do want a new house. So you have this great house, you raised your kids or whatever you did with it, you sell that, you take that amount of money. And usually in Southern California, that's a lot of money, especially if you've paid the house off. And many, many, many borrowers in that age bracket have paid their house off. So if you are one of these people, but you don't want to rent, you want to own, you don't want to make a payment, you take half of the money that you're going to need to purchase the new house, from the money that you already made by selling your old house. You buy that new house on a reverse mortgage. So 50% is cash and the rest is a mortgage that you will never pay a dime on, because the reverse mortgage product, one of the great elements of it is that you do not have to make payments. You can make payments. You can make partial payments. You can make interest-only payments. But if you are on a fixed income, or if you are on one of these people who just sees their life and how they want to live it, and they want to take the money that they currently have and live a good life, that is a terrific product for those people out there who want to do something like that. That reverse mortgage purchase, and Nina, we'll have her on next week or the week after, and she can begin to talk a little bit about it. Looking at first-time home buyers, let's talk about that for a second. Daryl, do you remember when you were a first-time home buyer?
I do, quite clearly.
Okay. Some of the reasons that you did or you didn't get into home buying before you eventually did.
I was just working one of those kind of careers and job paths where there was some time in between, and it was a business where you do move around a lot.
Yeah.
In the radio business, and that's good for you, but maybe not reflects well when a banker takes a look at your situation. And plus, you never really knew, ultimately where you're going to end up. It's like the WKRP in Cincinnati story.
If anybody in our listening audience has no idea what that is, look it up.
You're too young to be.
It is a very funny. It was a very funny television show back in the 70s, 80s, something like that.
Yeah, Dr. Johnny Fever, Howard Hessman, played a disc jockey who had been on top in a major market and sort of decided he would go to Cincinnati and cool his heels, or
So when you got into the home buying market, you got into it when you were younger, when you were a little bit older, when you were making more money. When did you do it?
Quite a bit older.
Okay. Yeah, exactly. Well, the new study that I read, Jan Swanson, our great friend over at Mortgage News Daily, who we've never talked to but quote all the time, she talked about who the new first-time home buyers are, and it surprised me, because she said that buyers over the age of 40 are actually the largest group of first-time home buyers. Now, that surprised me. I would think in your late 20s, early 30s.
I was 40 plus, a couple.
Okay.
But, I understand what she's saying, because, and again, a reflection on some of the younger generation, a lot of them don't think about that, and it doesn't matter to them anymore. Being a home buyer used to be a item of prestige. I mean, I remember families getting together and sitting around and talking about how much square foot they had, how much they had
exactly. There was a home ownership pride that doesn't necessarily exist to the younger buyer today.
Yeah, it used to be something that was extremely important, and it became less important.
Yeah, I think that's true. Well, this demographic, this 40-year-old demographic, right, apparently got a lot of money. She says they are confident about their finances, might even pay cash for their homes. Now, think about that for a second. This is a group of first-time home buyers that can afford it, can pay cash.
Well, I mean, they've obviously squirreled away some amount of money.
You would have to. If you're in the workforce, let's say you go to college, or you don't go to college, so you're in the workforce 20-plus years.
Yeah. I think that there's also more of an entrepreneurial spirit in the current younger generation, as far as the kind of money they can make and what risks they will take.
Well, I like the fact that this large group, first-time home buyer, is anxious to get into the market and really wants to buy something. If you're talking about San Bernardino and Riverside, and you're out there, you're driving around in your car right now, and you fit this demographic, you are not alone. You did not miss out on the boat. There are homes available. Who were we talking to last week about up in Hemet and up in Hesperia and up in Paris, and a lot of these neighborhoods which you probably hadn't thought much about? A lot of new home building going on, and the median price point to these homes is $250,000 to $350,000. Now that is you can't find that in a lot of places in San Bernardino and Riverside, and you certainly can't find it in Orange County, Ventura County, or LA County.
Well, I mean, there's a downside to some of that area as well, because it gets hot. I mean, really hot.
Well, there's no question it gets hot, but the built-in infrastructure that is continuing to develop. What city were we talking about? Ladera Heights, and I'm trying to think of some other ones that 25, 30 years ago were, farm towns or cattle poke towns. And now, of course, they're all built up like Rancho Cucamonga is another example of a town
huge, yeah.
that 25 years ago just wasn't the town it is today. It's just built up, expensive, and has all the infrastructure.
Hemet, Hesperia,
Right.
Great places there.
They're great places, but you're right. It is hot out there on that I-15 corridor. It is really hot.
But not everybody can afford a house at the beach, so that's where you go.
Well, always when we're looking at an 11-year run here, right, of real estate prices. Now, granted, real estate prices fell up to 50 to 60% in some areas, certainly across Southern California. But if you are experiencing or had experienced that, it has come all roaring all the way back and exceeded what the last highs were by a good substantial amount. And seeing that and taking advantage of that is something that I think, obviously this demographic of above 40, but if you are looking for that and a first-time home buyer, people from the beach flow inwards in order to afford properties. That's just the way it is. In a down market, it's the reverse. And those Inland Empire housing in those areas that you might necessarily not have heard about, those are the ones that fall first. But right now, there's a lot of building going on out there. There's a lot of opportunity out there, and this demographic of that 40-year-old first-time home buyer is primed to be able to get out there, get a good mortgage, which we can help you with if you want to give us a call. Anyway, I'm Jeff Barton. Thanks, Harold, for jumping in again.
Pleasure.
And we will be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Ten seconds. Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929 is our telephone number over here. Write down the phone number. When you hear something that you want to ask a question, please pick up that phone and dial. I can help you by either answering on air or calling you back later. We get many calls during the show, and a lot of times I just ignore them. Why? It's not because I'm ignoring you. It's because I want to be able to answer or talk to the person that I'm talking to on the phone. We get good guests, people that come on who can explain to you things, people that might be able to help you understand a loan program or maybe a way by which you can fight the government in order to get something that's yours. How does that sound to anybody? Anyway, one of the guys that does that for a living is my next guest, Joe Durst from American Disability Law, and he joins us from Phoenix, Arizona. Joe, how are you?
I'm good. How are you?
Me, I'm okay. Thank you. I'm a little tired, to be honest with you. I mean, we're in an 11-year run here of good mortgage rates and a expansive real estate market. But I wanted to ask you about you and what you do down at American Disability Law.
Fire away.
Okay, so what is it that you do for people? I know what you do, but I'm trying to get you to explain it to the audience. What is it that you do for people, and how do you help them, especially in the Social Security area?
Okay, we're a Social Security disability law firm representing claimants all over the Southwest, but we do have clients who move across the country, and we often travel to represent those clients. But basically what we do is we help people get on Social Security disability. Social Security has a program. Some people know about it. I wasn't really that aware of it when I was going to law school until I got in this area. But they have programs for people who are disabled, and if you can prove that you are unable to work full-time using your medical records, then they will give you disability payments. And there are various types and amounts that you can be paid. Vary by person, and it's a very complex area of law. So what we do is we help people with getting the records, submitting them to Social Security, making sure Social Security has everything that they need to make a determination. And then the main thing that I do is represent people at disability hearings, which is after they've been denied a couple of times. And we actually go into an administrative hearing with a disability judge, and we present the case and take testimony, and then the judge will issue a decision after the hearing. That's kind of in a nutshell what we do.
No, it's very interesting. And okay, so let's say, is this something not a workers' compensation issue? It's like I got hurt on the job, or is this more about health issue? I have a disease that prevents me from doing my job. Which how does that work?
Well, some of our clients do have workman comp cases, and or they're on short or long-term disability, which is through a private insurance company through their work.
I see.
They're not related really in any way, other than the fact that we want your workman's comp file with all the evidence that's in there, as well as your disability, long-term and short-term disability file, because it may contain doctor evaluations for the purposes of that case that we can use in your case. But this program, there are programs in Social Security that are geared towards workers who have work history, but there's also a program called Supplemental Security Income, which they created because some people have never worked and thus never paid into the system.
Right.
And if they're disabled, they can't work.
I see. No, that's interesting, because that was my next line of questions was, okay, let's say, is this, you have to have worked and paid into the system in order to use your services to get what's owed or what, you can get through the disability? Or you're saying, no, you don't have to, right?
Yes, you can still apply for Supplemental Security Income, which we call SSI. And that pays $775 a month. And it is reduced by any income. It's what we call welfare disability. So if you're making any money on the side as a part-time job, they will reduce the amount that you'll receive. And some people are just working enough part-time that they don't qualify for that type of disability. But it's something that wasn't available when the Social Security Act was first passed. They had to add a few titles to it to add these other programs.
Now, when you represent somebody in court, what happens really is that the administrator, whoever denies or accepts these claims, just says, no, you don't have enough evidence, or no, I don't believe that, or what's the process of denial? And then obviously what you do is to come in and try to rectify the situation.
Well, the first step is an initial review by Social Security doctors and evaluators.
I see.
And so you file an application and submit evidence questionnaires that they have asking, what are your symptoms and why can't you work, and what are you capable of doing from day to day, and what are you not capable of doing. And then they compare that to your medical records and decide whether they believe that you would be so limited that there would be no jobs out there that you could do. If you are denied at that level, you have 60 days to appeal, and they basically do another round of that, asking for more evidence and more evaluation. And if you're denied at that, then you request a hearing. And the hearing wait time right now is about 1.5 years.
Oh, boy.
So during this time period, our clients are literally just waiting for a hearing to be scheduled.
Unbelievable.
I can go into the hearing process if you want to discuss that too.
Well, it's interesting. Obviously, there's a heck of a demand. If you're saying that either that or there's very few judges that do this, which is it?
I'm sorry, what was the question?
There's either a heck of a demand or very few judges that do this, or is it a bit of both?
It's a bit of both.
Mm-hmm.
So I'm estimating, but Phoenix is, I don't even know how many people we have here, but I know that our firm handles about 1,500 clients on average at any one time, and we have maybe 10 judges in each area, maybe a few more. And there's a hiring freeze in the federal government right now, so if they lose an employee, they're not allowed to hire someone new. They have to transfer people around. So there's a limit on the staff and resources that the judges have. And so these judges will do maybe 5 hearings a day, or maybe 10 or 15 a week total, and then they have to issue these decisions, and that can take 3 to 6 months for those decisions to come out. So that's the problem. Is there's a lot of demand, but there's also just not enough judges to handle it.
I see. The people that you're helping, that they can't work. They're not, physically able to work, and yet they have to wait almost 2 years before they even get a real decision, whether they're in or out.
More like 3 years.
Oh, my gosh. What happens if they don't get denied? That's it? Or do they have a further way to get some redress.
If you're denied at that level by the judge, then you, again, have 60 days to appeal. It goes to the Appeals Council, which is one office in Falls Church, Virginia, that reviews all the nationwide unfavorable decisions and that are appealed, and they review it independently. Now, they ask for a brief from an attorney, and we do briefs, but we tend to find that they disregard them. And that process can take another 1 to 2 years before you get a response from the Appeals Council, and the success rate is so minimal that we're basically not appealing most cases because we know we won't be able to win unless we want to take it to federal court, which would be the next step. And we only take maybe 5 or 10 cases to federal court per year out of 1,500. So you can understand how low that grant rate is.
Absolutely. If someone had an issue or someone had questions, how would they get in touch with you?
You would call you can go to our website, americandisability.law. It's not .com, it's .law. And you can fill out a questionnaire, a very short form that will be sent to our intake people. Or you can call our main office line, which is 602-200-9090. I can't remember our 1-800 number, but we do have a toll-free 1-800 number. It would be on our website. So that's the way to get in touch with us, and we will take, and we are able to take cases anywhere in the country because it doesn't matter, unlike other areas of law where you have to be licensed in the state to practice law in that state. Because we're dealing with the federal government, we just have to be licensed anywhere.
I see.
And we can travel to other states.
Because this is federal jurisdiction, so a license in one state allows you to practice in any state. That's excellent information. Joe, thank you very much for coming on the show, explaining what you do, and I really appreciate it. I want to have you back again. Thanks.
Yeah, thank you.
Thank you very much. That's Joe Durst from American Disability Law. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number over here. And if you pick up the phone and give us a call, we can try to help you by answering questions that you're going to have about mortgages, about real estate, about buying, about selling, about what the machinations of the market are. Are the rates going to go up? Are they going to go down? Do we see advanced inventory? Do we see declining inventory? What is happening with this trade war? How is my job? Is it going to be secure next year? What kind of job are they going to have in the future? All of these things we touch on each and every show. Mortgages are much more than just, can I afford, that's the boiled down version is, can I afford the monthly payment? A lot of people, that's all they look at, okay? They don't look at a lot of the other benefits or the problems inherent in owning a home and getting a mortgage. And one of the reasons that they don't do that is because they're just concentrated on one thing. Okay, I've got $1,000 I can spend on my mortgage a month. I've got $2,500. I've got $3. Whatever the number is, that's what I can afford. And it's all based on this formula of, I've got this much money to spend. I need to be able to get this size mortgage. And every month I make this amount of money. So your debt to income level is determining what exactly you can afford. Now, when you calculate income, very important, you have to make sure that the income that you actually make every month, whether it's you're declaring it on your taxes, whether your W-2s are declaring it, or whether your bank statements are declaring it. Now, I've talked about 3 different things, and that's 3 different types of loan products. You can either get a standard 30-year fixed-rate mortgage, and within that, if you want to buy and you put 20% down and you're a W-2 employee, that's a pretty good loan, especially if you have a 700 or above FICO score. All of those things mean that that loan is probably a very good loan. You could go and dictate a lot of good terms with your lender, with your mortgage broker, or your mortgage banker. Darryl, you want to say something?
Well, I was just talking to a friend before the show. He lives up in Atascadero. He's refining his house for another 30 years. And he locked in at like 3.75. And he said, look, my payment's going to go from $1,100 a month down to $700 a month.
Right.
That's a 30-year, and I'll be 103 if I see the end of this loan. He was just happy to have the extra $350 in his pocket every month.
Yeah, I agree with that 100%. And the rates, now let's just talk rates for a second, okay? I was on a roll there, and that I was mercifully interrupted, and talking about how to save somebody a few $100 a month. Now, maybe for some of you who listen to the show, that's not a big deal. But for this person and many, many other, millions of homeowners, saving $400 or $500 a month is a big deal, especially if you're on a fixed income, especially if you're an older American who don't work or haven't worked for a while. Saving that kind of money is the difference between, being able to afford really good food or being able to take a small vacation or not, and just scraping money together to be able to pay that mortgage. That's an excellent way to look at it if you are, in fact, looking at it. So rates today, what are the rates? I'm going to pull open my little notebook here. Okay, the FHA, 30-year fixed, 15-year fixed, and 5/1 ARMs. I had a friend who sent me a loan application that he locked in a 5/1 ARM at 2.78%. Now, that is a smoking rate. I don't see that on my rate sheet at all. But if you can get something like that on a 5/1 ARM, especially if you're going to move, especially if you got a job that pushes you around a little bit, or if you just want an introductory rate for 5 years fixed that then adjusts. Those adjustable rates are pretty good. They don't really go up more than a point a year, and usually not even that. I had some clients who did have a couple of rates that adjusted by a point, but it's a small adjustment. It's a short adjustment. In an escalating economy, i.e. everyone's working, right? The job market is good. The economy is good. Usually what you have is a very small adjustment in your rate if you have an adjustable rate mortgage. If it's a down market, obviously you're going to see some hurting because you're going to be worried about your job. It's possible that you don't have the monthly income to be able to pay because you're worried about your job and your income falters. Those are the people that if you get a rate adjustment of a point or more is really going to hurt. So those people are really, unless you're short on being able to get out of a loan in 4 or 5 years, either selling the house or you're going to rent it out or you're moving or however you figure it out, I think that 15-year is good. And today the 15-year fixed is 3.375. Now that is an amazing product. If you have a 30-year fix right now at, let's say, 4.5% to 5%, and you want to keep roughly the same payment, look at this 15-year option at 3.75, 3.375. The difference is a point and a half, and because you're going from a 15 to a 30, the payments may be a little bit more, but you pay off the house in 15 years. Wouldn't that be great? Instead of saying, okay, when my baby gets out of college, I might be close to getting paid off. No, you can get it paid off before they go into high school. 15 years, that's pretty quick. Let's say the VA, FHA loans, 3.375. Again, a smoking rate. If you're out there and you only have down payment of 3.5%, this is a good loan for you. It's a standard FHA or a VA loan. Both of these loans carry with them some good guarantees. Obviously, you have the insurance that you're paying in the FHA, and the VA loan is a fully guaranteed loan. So both of those are great. If you are looking for a standard 30-year fixed rate mortgage, currently the average of that is 3.75. The reason for that, why is the reason for that? We've had rates go up and down a lot in the last 2 or 3 weeks. And last week at this time, I think we were 3.5%. So it's gone up, from my estimation, a quarter point in 1 week. That's a lot. If it kept going like that, that would be terrible for the market. It would be terrible for you if you're trying to get that mortgage as well. The reason it goes up, we talked a lot about bond sales. We talk a lot about treasury yields, and both of these elements to what constitutes or dictates your mortgage rate. Fluctuating a lot lately because, believe it or not, we still talk about it. Last week, the president said that they were going to make a deal with China on $50 billion worth of farm products. Now, this made the market react. Obviously, they reacted well. Usually it means that, people pull their money out of a safe haven like a treasury bond and put it into the stock market because it's going up. And because of these automatic trading and because of the way that the yield is offered or not offered on products that dictate to the mortgage market, that's why we saw the rates rise, because the yield had to rise, so therefore the mortgage rate has to rise. Somebody's got to pay for that yield. And so that's why, in fact, the rates did rise, because people took their money out of treasuries and put it into the stock market. Well, as one of the guys who was I talked to a guy from Ohio who said that he wasn't sure that the trade actually was going to happen with China because, like many of the promises in the current trade war, they haven't come to fruition, and that's a problem. So we may see the rates go back down, i.e. people will get out of the stock market and go back into the treasury bonds, i.e. the yields will diminish, i.e. the mortgage rate goes down. And that's really what's kept this mortgage market in flux. We have a economic recovery that has been gone on for 11, almost 12 years, expansion every month, every quarter. GDP goes up, and the expansion continues. And this is a good thing for most people. So if the trade war, if the bond market continues in this flux, we're going to see rates go up and down like this. But we're not going to see 4.5% for a while. The reason I say that is because I think the demand for treasuries is always going to be there, especially with Brexit going on and some of the European countries already going to a zero or a negative in terms of what they're lending out for their money, their monetary policy. All of that means that a lot of that money, foreign money, is going to flow into the treasuries here in the U.S. because we're still at I think the range is 2.25 to 2.75. I think that's what the range is on the treasury bonds on the yields. The yields are currently 1.7, I saw today. Anyway, the cost, the yields, all these things mean that we're going to see mortgage interest rates at least between the 4 and the 3.5 to 4%. But in terms of the micro, where it goes from 3.75 to 3.875 back down to 3.625, which means a lot on a 30-year fixed rate mortgage, we're going to see some volatility. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for tuning in. Thanks for listening each and every week, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.